Hi there, and welcome to week 10's lecture on the bond market. So far in this module, we've covered the regulations, we've talked about the insurance sector, and we went on to talk about banking in the context of a capitalist society and the intermediation process. And the bond market is quite fundamental to the financial system when it comes to raising finance via debt. So if we looked at the diagram regarding the ways of getting cash from ultimate lenders to ultimate borrowers, the second pathway was via the market, the capital markets. And the bond market is certainly one of these. So a way of companies or governments raising large-scale debt for a longer term would be to issue bonds. So ultimate borrowers would issue bonds that ultimate lenders would potentially purchase, but they're also traded on the secondary market. And these are the products we're going to talk about today. So in this lecture, we're going to start by defining what the bonds are and describing the market. Then we're going to work out how they're priced using simple interest calculations and discounted cash flow calculations. Then we'll be working out how the yields and yield to maturities are calculated if they are traded within the secondary market. And in a separate lecture, I have covered the theories that underpin the shape of the yield curve. So what is a bond? Bond is a debt characteristic product where they are generally borrowings for more than 1 year. In the United States, any borrowing by a corporation that is longer than 270 days is a bond product. But typically, we would say anything longer than 1 year up to or potentially infinity. Normally, bonds typically are issued for 5 years up to 30 years. But like I said, there's something called a perpetual bond. That means it technically doesn't have an end date. And companies can issue bonds as an alternative to raising capital compared to issuing of equity or shares, which we'll cover in next week's lecture. Now, the benefit of issuing bonds is there's a range of tax benefits when it comes to the interest payments. Every year, a bond will pay an interest. That interest typically is fixed, and that's what's known as coupon payment. And that coupon payment is paid out before tax, thus reducing the tax bill. And bonds can be issued a lot quicker and a lot easier than the issuance of equity. Bonds are a legal contract, and they will have a legal covenants attached to them. So some bonds will have collateral attached. So if the issuer of the bond was unable to pay the coupon payments or the bond value back at the end of the bond, then the investors may receive collateral. Also, in the pecking order, when it comes to bankruptcy of an organisation, any bondholders would be paid out before any shareholders would be paid out. So have a think now, how long do you think is the longest dated bond? Now, I have mentioned something called perpetual, which means the bond technically doesn't have a fixed end date, but there has been some historic bonds in the past that were issued with a fixed end date. What do you think the longest is? Well, here's some examples, and you can see the names that were attached to them. So Disney actually issued a 100-year bond called the Sleeping Beauty bond in 1993. And obviously we can go and look for that bond now. As an investor, this is quite a stable product. If you look at the interest payment, you receive 7.55% semi-annually. Now what that means for a bond is if the bond has, one bond has a $100 value, then every year you'd receive $7.55. But that payment would be split in half. So every semi-annual you would receive $3.77.5. And then if you are lucky enough to survive until 2093, you would then receive the par value of the bond back. But the most likelihood is that you'll have sold it off in the secondary market. We also have the Toronto, Grey and Bruce Railway, which is now known as the Canadian Pacific Corporation. They issued a 1,000-year bond, which technically is perpetual, but it does have an end date, which is 2,883. So I hope we do get to see that someday. But again, if you're a fixed income investor, then you might potentially buy this bond, just knowing that if you hold onto it, that you will receive 4% on an annual basis. And then lastly, the UK government, post the wars, actually issued a range of perpetual bonds that didn't have an end date to help kickstart the economy and go on a infrastructure spend and build project post the wars. And these perpetual bonds, what were known as the war loans, were actually paid back and ended in July 2015. That's the thing with perpetual bonds. They don't have an end date, but they can potentially be called back. So that's what's known as a callable bond, where they are paid off before whenever the end date is set. And as an investor in callable bonds or perpetual bonds, you always run the risk that this bond will be called back and paid off at any point in time. Thus, you'll be wanting to be compensated for the likelihood of someone paying back a bond early. Now let's look at the eye-watering scale of the amount of bond debt that's in issuance right now. So this market is a global market. Every country's government, lots of corporations within a country will issue bond debt. And you can see in the latest report from the International Bank of Settlement from September that in Q2 of 2020, the eye-watering amount of bond debt in issue was $24,863 billion US. Hi there, and welcome to this continuation of the bond lecture. On the Bank of International Settlement website, they have a debt to security statistics page which covers the level of government and corporate debt that's in insurance. And this is updated quarterly, with the data being broken down by different countries and deviations between developed and developing countries. You can get it in a format where you can extract data yourself, or we can simply look at the PDF overall summary. And this is before where I got the figure of $24,863 billion US. But you can see the summary here in more detail. Also, we can look at the individual country. So we can go here, type in United Kingdom, and then that'll generate a PDF with more specific breakdowns regarding bond debt in the UK and how it's issued and what currencies, for instance. So, with the debt of bonds, as I've noted earlier, it can be anything from 1 year up to perpetual, but typically we would break them down into these terminologies. So a shorter dated bond would be less than 5 years, a medium dated would be between 5 and 15, and long would be greater than 15. But ultimately it depends on which textbook you read. These boundaries are rather blurred and they're not really set in stone as such. I would be careful when you look at the secondary market. You might see a maturity that ends within the next couple of years. And you think, oh, well, that's a shorter dated bond. Well, you need to actually look, when was it issued? Because this bond that might be ending next week was probably issued 30 years ago. So whenever we look at bonds and how long they are, we need to obviously look at the difference between the date of issuance and the date of maturity, the end date of the bond. If you watch the summary lecture, we covered a range of different bond types. And just to recap them here, we have the most known one, which is the government-issued bonds. Gilts is the other word for them. And this is debt that's issued by central governments. We also have the municipal bonds, which are also government debt, but they tend to be issued by, in the US, local states, or with the UK, potential councils can issue these. The top one is corporate bonds, and this is bonds that are issued by companies of a higher credit rating, typically. And as noted earlier, corporate bonds are an alternative to raising finance via bank loans or equity capital. Typically, corporate bonds are backed by certain assets, certain collateral that is attached to the bond covenants, the legal document. And this is different to the concept of a debenture. These are bonds as well, but they're not asset-backed. And typically, debentures may be known as what's a revenue bond, where the coupons are not fixed as an interest, but they're more linked to revenue and performance of the organisation. We also have convertible bonds, where these are obviously a debt product issued normally like a bond. However, later on they can be converted into shares, and this is if the investor decides to convert the bond into a share. Now, why would you do this? Because bonds and equity have very different characteristics from a risk point of view. Well, it depends on ultimately the share price and the price of the bond. If it makes financial sense that the share price of the organisation is quite substantial relative to the price of the bond, then there's a likelihood that you could actually benefit from converting to shares and then instantly selling the shares off. There's also zero coupon bonds, where this is got very similar characteristics to a T-bill, where the bond is issued at a discount. You're paid no coupons during the time of the bond, but at the end of the bond you get the par value back. So this is like you would potentially buy the bond today for £50, and then in 10 years time you'll get £100 back. Now, why would you do that? It's a long dated discount product. Well, this could be a case of where you don't need coupon payments, because if you get coupon payments then potentially that needs to be reinvested or you need to do something with it. Potentially you might buy that zero coupon bond at a heavy discount, wait a while for it to crystallize, and then use that crystallized payment for something. So in the US it's very popular when it comes to paying university tuition fees. So families would buy zero coupon bonds when the child's young, hoping that they would obviously crystallize and mature where just around the time kids would go to university to pay off their fees, for instance. So it's really for investors that don't really want to receive coupon payments and face the potential reinvestment risk of what you actually do with these cash flows. And then lastly here we've got the euro bonds, which is similar to when we talked about the euro market in the money market, where these are bonds which are issued in countries outside of your domicile, raising the currency. And as noted in the money markets, this would be potentially to help avoid potential foreign exchange rate risk when translating currencies from one to another, but also it's due to less regulation. If you have a dollar-denominated product outside the US, you're not subject to the federal regulations, but you still hold the bond product in dollars, but not in the US. So it is another way of avoiding the regulations as we discussed last week. So why would you invest in bonds? Well, naturally, from an investor point of view, bondholders are risk averse. They're seen as a lower risk to equities, and they pay a fixed income. So if you're an investor who wants regular interest payments, then you're more likely to go for a bond than equity because dividends are not guaranteed. Bonds are issued in the primary market, so companies will issue bonds that people will purchase, then typically they're sold in the secondary market between investors. And the price of the bond depends on a number of factors, but ultimately it is the interest rate in the market at the time. Because bonds are fixed interest typically, so if you issue a bond that's at 5%, if the market interest rate is 1%, and then that changes to 0.5%, so the market rate or the Bank of England base rate, for example, drops, then that bond is still going to be at 5%. So if market interest rates are low and the return on bonds is high, then the demand to buy that bond, which is going to give you 5% interest compared to the market at 0.5%, is going to be very attractive. Therefore, the bond price will go up. So there's an inverse relationship between market interest rates and bond prices. But we also have to remember that bonds have an end date. And at the end date, the maturity value, the par value of the bond, is what's paid back. So if each bond's wrote at £100, then as you get closer to the maturity date, irrespective of what the market rate is, the bond price will start to converge all the way to £100. Because if you buy it a day before maturity, the next day you're only going to get £100 back and the last coupon payment. So through the lifetime of the bond price can fluctuate up and down depending on market interest rates and its popularity of the product. But as you get closer to maturity, it will always converge towards the par value. Similar to what we mentioned last week when we were talking about T-bills. And as noted on the slide there, investors prefer them because they provide a fixed income, and these coupons are a legal payment, a legal requirement of the bond. If they're not paid, it goes into default. The par value is set on the bond and is wrote on the bond itself, so we know what the par value at maturity would be. Also, we know what potential collateral is in place if the bond issuer was to default. And lastly, the bondholders are paid ahead of any sort of shareholders in the event of a collapse or bankruptcy of the organisation. When we talk about the pricing of the bond, you'll have watched the lecture on yield curve theory and the shape of the yield curve and what is built within the yield curve. But the top slice of the yield curve relates to credit risk. And typically bonds have a lower overall risk characteristic than equity, but there's always an element of default risk. The risk of you buying the debt and the person that issued the debt not paying it back. On the slide here, you have the credit rating agencies and how they rate individual bonds. So credit ratings normally provide a rating for, if it's a company, they'll provide the rating for the company, but then individual bonds that they issue also have to be given a credit rating. And they're given the credit rating at the time of issue. And therefore, it is an incentive for organisations to have a higher credit rating when they issue bonds, because that coupon payment or the coupon rate of the bond, the credit risk at the time of issue impacts the rate that the company must issue the bond at to attract investors. Ultimately, if you have a low, poor credit rating, you're going to have to issue a bond with a higher interest or higher coupon to attract investors to buy it. From the table here, you can see that pretty much anything that's AA to AAA is what's known as high investment grade. This is typically your sovereign debt, so this is typically governments. There is a couple of organisations with very healthy balance sheets that also might get their bond rated at AA and above. Then we have what's known as medium grade, which is still A's, low A's. Then we have low to medium, which tends to be your B's. But anything under triple B minus, so if you've got BB, that's what's known as junk or more speculative bonds. And this obviously depends on the investor, because investors that are looking for income but are also willing to take a little bit of risk would potentially invest in these junk bonds or these more speculative high risk bonds. But it's ultimately important for the company that is issuing the bond to have a higher credit rating, and certainly have a higher credit rating at the time of issue. It is possible that a company could issue a bond one day being rated AA, but then if they have a financial hit that year, the next year when they issue bonds, it could be in the Bs, and therefore they'd have to charge a higher interest rate on the coupon. So it is possible that this could occur. If you are issuing the likes of a more speculative graded bond, then you're probably going to attach more collateral to the bond in the case of default. So if it's a higher risk bond, you may be putting a covenant that you get first claim if the bond goes into default. There may be a claim on certain assets or certain securities of the organisation. So these are ways of how the company can potentially attract these investors by offering some sort of collateral if it is to go into default. Now, I have mentioned that bonds, certainly from sovereign wealth, tends to be AAA rating, the likelihood that it's not going to default. The reason for this is governments, certainly like the US and the UK and most Europe, in law, they have the ability to tax their population. Thus, if they need to pay debt back, then they can obviously tax their population to retrieve the payments to pay the bondholders back. That's why potentially known as risk-free. However, how risk-free is government debt? Well, if you look at the two links here from the United States, this is about the concept of the government shutdowns you may have heard of. And this is because of the US's tendency to rely on short-term borrowings. Therefore, the legislators in the country have to keep raising the debt ceiling on how much the US can actually borrow to fund its economy and infrastructure projects. So these government shutdowns is when the likes of Congress don't agree on increasing the debt ceiling. And you can see there from 2014 up to 2019, two examples in the scale of the debt ceiling being increased further and further to allow for more borrowing. And when the debt ceiling is not increased, this is where the government shuts down because they don't have the liquidity to pay for the running of the day-to-day running of the government because they can't borrow. So this is kind of signals that, is it really risk-free if the government kind of shut down because they can't agree on more borrowing? And let's just fast forward to now. We've looked at the BIS data. In a couple of months' time, again, we'll look back at the BIS data on how much bonds are in issue. But the amount of government spending and government borrowing recently, due to the COVID pandemic and trying to prop up the economies, you've seen the amount of borrowing spiral compared to what was planned in any sort of government budget. And just to conclude this part one, if we have a look at the recent figures from the National Office of Statistics, and if you research back to the government Rishi Sunak spending review earlier in the week, we can see the amount of UK borrowing has substantially increased compared to what was planned in any sort of budget in the past. And certainly since 2000, you can see the scale of public sector net debt, and this debt really has come from government borrowings. Now, obviously in the UK, since the likes of 2010, we have been recovering from the financial crisis, and interest rates in the country were 0.5% or 50 basis point for a very long time. Therefore, government debt or issuing of government debt was a lot cheaper in the past because of the Bank of England base rate being very low, and that is still the case today. So the government have, over this period, has increased their borrowing substantially. However, it could be noted that this borrowing is at a much cheaper rate historically than they ever have been able to in the past. But then look at the spike in 2020. Again, base rates now are its lowest ever in the UK, so the borrowing is a lot cheaper. And what we've seen in the seminar last week, that the T-bill rate had actually turned negative for short-term borrowings. But governments in the UK are issuing bonds now at really low coupon payments. But investors will still buy them because it is government debt and it is classed as safe. But have a look at these numbers. Is this borrowing sustainable? How will the government get the UK finances back on track to enable them to pay the coupons for the bondholders? And that concludes part 1.